right. It's now 8:30 on the dot. We're awaiting these numbers, of course. It's the November read on Consumer Price Index, up 0.8 on headline. That, in a way, is good news because that 0.9 in the rearview mirror was the highest level since 2008. Let's call it 13 years. If you strip out the all-important food and energy, it's up 0.5%, up 4.5, and that is moderating from some of the recent higher levels, and that is a good thing. But here's the Moneyball numbers year over year. Year over year, up 6.8, and this, of course, is a new record. That is the highest level since June of 1982. And if we look at food and energy year over year, it's up 4.9. And that also is a high water mark. That is the highest level since June of 1991. We'll call it 30 years. These numbers were expected. As a matter of fact, on the year-over-year numbers, the analysts and sources I talked to nailed it. They had the predictions right on. And if you look at what's going on with the interest rate complex, it really isn't moving all that much on any of them. We were testing the 70 over 70 level in twos. It's right there. It dipped a bit. Now it's right there. We're hovering right around and below 150. And many are probably scratching their heads why. I think much of this was built in. I still think that there are many that believe some of these issues will moderate. But as your last guest, the topic was energy. I will continue to hang my hat on some of these longer-term predictions that lack of investment in the energy complex due to policy mistakes and the handoff from fossil to renewable is going to definitely continue to put upward pressure on these. Many think we're going to see 125 to 150 in the years ahead on crude oil, and I'm not sure that I can disagree with that. Joe, back to you.
Just had Jeff Curry from Goldman on. He said not just oil underinvestment, Rick, across the entire commodities complex.
All fossil fuels.
Not just fossil fuels.
And commodities.
Copper,
metals. Rare earth commodities in general. Yes. Yeah. Well, that's a great thing, right? Because as we get ready to have everybody switch over to batteries, if it was like I Dream of Jeannie, you wiggle your nose, you do your arm thing, and everybody now has battery cars. Where are we going to get all the nickel? Where are we going to get the lithium? Where are we going to get all the rare minerals and earths? What, from China? Because I know that the places they're located in the U.S., nobody's going to let you put a shovel there. The whole thing just almost defies logic. Our hearts are in the right place. We're thinking correctly. But how we move along and implement is completely fraught with errors.
Rick, I think I Dream of Jeannie blinked. I think it was Samantha that did the nose. So just to get things exactly right, right? Bewitched. Not anyway. Yeah, Steve, you got any comments?
On this energy thing, I think that it's a little premature to say. I think what you're talking about is something that's going to affect oil and gas down the road. I think right now you still have an industry struggling to get back. When I look at rig counts, they seem to be on the rise. So, and also the idea that OPEC is still coming in below where it was pre-pandemic is not an issue of U.S. investment. We've come back up about 800,000 barrels, I think, from the low. I look at the rig count, it's going up every week. So I think you're right. Over time, there's going to be an issue with this poorly executed handoff. I don't think that's what's going on right now with energy prices. It's just my take on that. But let me just give you analysis on the CPI, which is a really technical analysis, which is that everything's up a lot. I think that's just the way to say it. I got food up, I got food at home, food away from home. The biggest increases are, as you guys were talking about, they were energy, 3.5%. And now one of the new things that's happening here is that shelter is up 0.4 on the month, 3.4% year over year. That's been on the rise. But when I look at the market, well, the fixed income complex, it looks like the 2-year is actually off now. It had sort of positioned itself for an even hotter number, up 72 basis points. Now it's down, now it's at 68 basis points, or 69, call it. I see the 10-year selling off. The market was well positioned for this, and the impression I get, at least the very initial impression from the market's reaction to this number, is it feels like the Fed is positioned for this. Remember what we're going to get. We're going to get a faster taper, probably double next week, and then an outlook for rate hikes that's going to put 2 or 3 rate hikes into 2022. The market is not screaming for more, and the market does not, at the moment, seem upset by what it's about to get. So what you have is you have this adjustment period before the number, And so far at the moment, and I even see, by the way, the stock futures rising. At the moment, it seems like everybody's kind of copacetic with where we're at, even though these numbers are hot and hot across the board. And I think there's more to come.
Right, with where we are, I think is sufficient. Mike Santoli, let me get you in here because I mean, you look at. I'm not saying the Starbucks thing is going to be just the end all be all for labor rights or for, but we definitely have wage pressure. It seems like we definitely have commodity pressure. These things are not good for stocks. When do we finally decide that multiples need to come down or that, you know, we've already paid it forward to such an extent that there's a pullback? Is it, don't you think that's inevitable or I don't know, maybe not?
I mean, multiples have been coming down. Profit margins have actually been probably a little more resilient than you might have expected, given what's going on the wage cost side. Also, I think we're still in this window of time before anybody is going to assertively say this is the new trend or the new trend is decisively worse on the inflation front than we thought, simply because we're still going up against, on an annual basis, very weak numbers from late, last year into early part of this year. It's not really until March that you're going up against the hot inflation numbers. So I think everybody can kind of reserve final judgment on that. Also, you know, at least in a grinding way, the multiples of the market have been coming down. Not too much, but earnings growth has been too strong. In terms of when it becomes a more critical issue, obviously, if all of those core elements of inflation, the drivers like rents, like wages, although wages aren't really measured, right? This is consumer prices. But as they get embedded into consumer prices, if we don't have the really strong nominal GDP growth to go along with it, that's when you might have to have a little bit, it's more of a zero-sum game than it is. All the numbers are going up, including wages, and the labor tightness is what it is. It's not just like a vote in a Starbucks store upstate is going to change the story. We can't find workers.
Shepard Smith here. Thanks for watching CNBC on YouTube.